Well, good afternoon and welcome to our viewers for this CEDA live stream. For those of you who don't know me, I'm Melinda Cilento. I'm the CEO of CEDA, and it's fantastic to be here with you today. Can I start by acknowledging that we all meet on Aboriginal land? I'm on the land of the Wurundjeri people of the Kulin Nation here in Melbourne, and I'd like to pay my respects to elders past, present and emerging, and acknowledge the role that they play, not just as custodians of land, but also of tradition and culture, and acknowledge the role that they play in sharing those with the rest of Australia in the spirit of reconciliation. You are here today watching our live stream where we're going to tackle the really tough issue, I think, of the outlook for the national economy. And of course, we're doing this virtually because CEDA, like most organisations, has had to pivot the way it operates in response to the COVID crisis. So we've pivoted to these digital events. I'm certainly enjoying them, and we've had fantastic engagement from our members and a wider audience. So thank you again for joining us. In addition to the live streams that we are doing, we've also been producing a lot of expanded content that you can access on our website at ceda.com.au. Of course, we're trying to do everything we can to keep our members and the wider community engaged and informed on the key issues impacting our economy and our society, particularly at this very uncertain time. So if you go and have a look at the website, you'll get access to the live streams we've had in the past, as well as blogs, podcasts, and lots of other things. So I would encourage you to go and have a look at the other material that we've got available. Can I just actually acknowledge also, I know that some of our viewers have had problems logging into our live stream events. I did want to apologise for that and just say thanks for your perseverance and patience with that. As we've pivoted to doing most of our things digitally and providing access across the country, you probably appreciate that some of our systems have had to shift pretty quickly, and we're doing everything we can to make that happen as smoothly as possible. But every now and then we have some problems. So we're working to fix those and to try to make it as smooth as possible. But for those of you who have been frustrated, I apologise for that, and hopefully we'll do a little bit better in the coming weeks and months. Today's event, like all of our live streams, is an interactive event. So you can put your questions to Bill and myself if you like. And you can do that through the link on your screen, or you can go to ceda.pigeonhole.at, and the passcode, which is now showing on the screen, is AUSECON, so AUSECON. Remember that acronym, because if you want to get on social media as well, hashtag AusEcon is what we're using for today's conversation. And of course, make sure you involve us in your tweets at CEDA_news. We will be asking a poll question through the Pigeonhole app as well. So if you want to give us your thoughts on what you think matters, please have a look at that question, and I'll be providing an update on the responses when we finish our conversation today. Now, without going on too much longer, it is my great pleasure to introduce our speaker today, Bill Evans. For anyone who is a follower of the Australian economy and its ups and downs, you will be familiar with Bill. He is, of course, the Chief Economist at Westpac. He's been in that role, I think, for about 30 years, he told me before we came online. And Bill and I were having a little bit of a reminisce about the number of times our sort of careers and roles have intersected over at least 2 decades, including, somewhat interestingly, given this is 2020, at the 2020 summit some years ago now. So Bill's going to speak to us for about 20 minutes, and then he and I will have a bit of a chat and we'll be taking questions. So with that, over to you, Bill.
Thanks a lot, Melinda, and it's great to be able to have a chat with you. Yes, you shouldn't have mentioned that 30 years. I remember I did join Westpac in 1991, and at the time I had been an investment banker who'd worked at the Reserve Bank before that, and the plan was to just stay at Westpac, a strong financial organisation, and weather out the recession, and then go back into the merchant banking world. But I'm still here, so I can certainly say that I remember the last recession quite well. I'll talk about three topics today. The first one is the economic outlook. The second one would be some comments on the current trade tensions with China. And thirdly, my view on markets. So let me start with the economic outlook. We expect the economy will contract by around 4% in 2020. It'll be made up of the minus 0.3 we've seen for the first quarter, minus 7% for the June quarter, plus 1.5% for the September quarter, and plus 2% for the December quarter. And of course, the second half of the year, that's 3.5% growth. That's 7% annualized. So that's a pretty respectable recovery that we would expect to occur as the economy reopens. You might say minus 7% when we saw that huge retail sales number of around 16% in the month of May. But what you have to remember is that the key driver of activity in the economy is the hours that people work, and hours worked are down by about 10% in April and May. So that will channel into a very substantial fall in the economy in the June quarter. However, there has been some pretty good news. I think I was very pleased in early May when we announced that the Westpac Consumer Sentiment Index had rebounded by 16.4%, having fallen by 20% in March and April. And of course, we saw another 6% rise in June. So the losses that we'd seen in March and April were pretty much wiped out by the recovery that we saw in May and June. Now, the level of the index is still only around about that 95 level, which was the average that we saw between September and February before COVID. But that was a pretty uninspiring number. At 95, that means that we still have a significant majority of pessimists relative to optimists. And I have to say, I'll be surprised if we see a further strong upward surge in the index from these levels. So we're dealing with a level of consumer sentiment that's certainly better than the collapse that we saw in March and April, but I still think that the level of sentiment is still pretty soft. There were two other interesting aspects of our surveys. The first one was a question about the 5-year outlook for the economy. And there, that component of the index is 50% higher than it was during that 1990s recession. And I think that's what telling us is that unlike the last recession, when there was despair, no one really knew how the recovery was going to come about. And in fact, my view is that the recovery really only started to take place after the December 1993 announcement that Sydney had won the Olympic Games. This time, people can see the other side. They can see that governments are easing their restrictions. They can see that we're being very successful in containing the virus. So I think people's expectations are quite different to that earlier recession when it was just ongoing despair. We used to talk about the jobless recovery. The second important aspect of the survey was, whereas we saw really strong recoveries in pretty much all of the components of the index in May and June, the one area that didn't recover was the outlook for house prices. So in April, I was shocked when we saw that index collapse by 50%, and yet in June, in May, it only recovered by about 5%. Another 10% recovery in June, but still a long, long way away from that February, March level, quite different to what we'd seen for the overall index. So I think that whilst there is optimism about that the recovery will be a lot nearer than it was in previous recessions, at the moment there's a high degree of skepticism about the outlook for house prices. But of course, the biggest story for recessions is always around the labour market. So if we look at the early 1980s recession, it took 6 years for the unemployment rate to get back to the pre-recession level. In the early 90s recession, it took 15 years to get back to the pre-recession level. And even in the GFC, which wasn't a technical recession, but it was obviously a contraction in one quarter and very weak world economy, after 12 years, we still hadn't got back to that 4% unemployment rate that we enjoyed going into the GFC. So the big concern with this recession is that will we have this long, painful period where the unemployment rate remains elevated? Our forecast is that the unemployment rate will peak at around 8.4% in August. It'll be down at around 8% by the end of the year, but still holding at 7% by the end of 2021. Because in 2021, we're only expecting the economy to rebound by around 3%. And what that'll mean is that by the end of 2021, the economy will still be operating at a level which is going to be lower than we saw at the end of 2019. Now, that contrasts substantially with the Reserve Bank, who are expecting growth next year to be a spectacular 6%. So whereas we're broadly in line with the Reserve Bank's forecast this year, we think the pace of the recovery next year will be much more constrained. Now, of course, we've recently seen some pretty eye-popping numbers around the labour market in the last couple of months. For the last 2 months, we've seen an 830,000 reduction in jobs, but 623,000 people decided not to stay in the labour force. They felt discouraged. They felt they couldn't find the opportunity to go looking for work. So because they left the labour force, the unemployment rate is only up at 7.1%. Without that group leaving the labour force, the unemployment rate would have been 11.3%. The other two aspects of the survey are that 360,000 workers indicated they were still attached to their job but didn't work any hours in the month. And another 1.2 million indicated, yes, we're attached to our job, but we've had a substantial reduction in the number of hours we've worked. And that's the effect of what I would call the JobKeeper effect, where companies have been able to keep their employees on the payroll without actually having work for them to do. So the next big challenge for the economy will be the unwinding of the JobKeeper and the JobSeeker packages, now time for September. And how the government deals with that is going to be a major challenge. So we think there's around 3 million workers that are covered by companies that were able to qualify for JobKeeper. That's a lot less than the 6 million the government originally estimated. But that was always looked to me to be an overestimate, given that if we look at some of the sectors that have been not particularly significantly affected, such as construction, finance, agriculture, mining, government, health, education, they all explain around 6 million workers out of the 13 million total workforce. So the 6 million initially estimated for JobKeeper was too high. The 3 million probably looks about right. And as I've indicated, 360,000 haven't worked at all but remain employed. Another 1.2 million have had their hours cut but remain employed. Some of the sectors that are really badly affected, such as arts, food, accommodation, they've had a 30% fall in employment before we look at how many jobs they've been able to keep with JobKeeper. So I think the key thing for the unravelling of the JobKeeper is going to be that those industries that are going to be affected by the ongoing restraints of foreign travel and social distancing, they're going to need to be assisted for a lot longer than just after September. But there will be other companies that have been using JobKeeper, have been keeping all of their workers employed and on higher salaries than JobKeeper, because JobKeeper was only really the minimum wage. Those companies that have been able to use the subsidy, they will probably lose that subsidy. And if at the same time the banks are asking them to resume their interest payments, there are real issues around how those companies will survive going into the December quarter. The key for me is going to be the October budget, and the October budget has to be one that will boost demand, because the stronger demand is in the December quarter. We're predicting a 2% lift in GDP in the December quarter. That's an 8% annualised pace, so that's quite respectable. But the stronger demand, the more we'll be able to smooth this transition out of JobKeeper and out of JobSeeker. So I would like to see a stimulatory budget. If we look at the three major challenges that continually face the Australian economy, low business investment, low growth in productivity, and weak household income growth, I would focus on the third one. Over the whole of 2019, domestic final demand was totally flat. And a lot of that was due to very weak growth in household disposable income. We understand why wages have been weak, partly related to weak productivity and partly related to a number of global factors, particularly around concerns around competition with technology, etc. But the tax rates for Australian households are too high. Bracket creep has been a factor in the last few years. The government has recognised that by legislating for tax cuts that begin in July 2022. My argument would be we bring those tax cuts forward to be announced in the budget in October. That'll cost about $14 billion a year. And when we look at that in the context of the $130 billion initial estimate for JobKeeper and even the $70 billion we're looking at today, I think that's eminently affordable, and that'll send a signal that the government is determined to boost demand. And I think that's the key to getting us through these difficult times. Let me now make a couple of comments about trade tensions with China. Obviously, that's a huge issue for Australia. China is our largest export market. They take about $150 billion in exports from Australia. I think about 50 of that 150 billion is vulnerable. I think 100 of the 150 billion is very safe. Of that 100, 65 billion is iron ore, around 20 billion is LNG, and the remainder is gold and base metals. And China is boosting its industrial investment. It's boosting its infrastructure investment. It sees lifting the housing market as being very important. So all of those factors suggest to me that China will continue to need those exports. The other group, bigger question mark, 13 billion of the 50 billion is agriculture. And we've seen the issues faced by the barley industry. That's about $1 billion of the 13. And various sectors of agriculture, cotton takes $1 billion, dairy $1 billion, wine about $1 billion, meat about $3 billion, wool around $2.5 billion. So it's spread across the spectrum. China takes about 25% of all our agricultural exports. So there are opportunities to redirect sales to other countries if China was to extend its restrictions that we're now seeing on barley to other parts of agriculture. But I do believe that that does represent a risk. Coal represents around 20 billion, about 8 billion in thermal coal, about 12 billion in coking coal. Thermal coal, of course, has a lot of problems with regard to the rebalancing of the use of energy. China's pretty much self-sufficient in thermal coal. It wants to support its local industry, and we've seen a number of occasions where China has blocked our thermal coal exports. So I think that remains a risk for Australia. And coking coal, of course, which goes into the blast furnace process, China's around 90% self-sufficient in coking coal. Fortunately, the 10% they're not self-sufficient in is a style of coking coal which Australia has that they will need. So we feel more comfortable there. But other countries, the steel-making industries, of course, have been hit hard by COVID. They have an excess supply of that coal as well. And so any tensions that China may feel towards Australia, we may have to feel some pain in the coking coal sector. And we have seen evidence in the past of blocking there. And the third one, which represents around 18 billion, which is tourism, about 6 billion, and students, about 12 billion. We've seen a lot of the issues there with China warning students about Australia being a dangerous place, with our own policies to stop foreign travel. So that sector also does represent a risk for Australia. So this is a very significant issue for Australia, I certainly believe, however, that 2/3 of our exports are pretty safe. Let me finally make some comments about markets. Westpac believes that the Aussie dollar will be up at 72 cents by the end of this year and 76 cents by the end of next year. A couple of factors that are giving me comfort there is the iron ore price has defied gravity. It's still over $100. It's benefiting from the supply restrictions that are coming from Brazil as a result of their difficulties in dealing with COVID. It's benefiting from China's thrust towards more industrialization, in a way trying to build as much in 9 months as they would normally take 12 months to cover the collapse that we saw in the first quarter. And I believe those pressures will continue through next year. In fact, we're looking at growth in China next year at 10%. The risk environment, of course, is always a big factor for the Aussie dollar, and we've seen the risk environment turn around sharply from the middle of March when the US share market recovered. And it was no coincidence that that was due to the strong signals from the US Federal Reserve that they were prepared to back the US financial markets with whatever was required. They're on the way to building their balance sheet to 10 trillion. They went into the COVID crisis with a balance sheet of about $4 trillion. They went into the GFC with a balance sheet of only $1 trillion. And I believe that if we were to see a deterioration in risk confidence over the next 3 to 6 months, the Federal Reserve will be there to support markets. If I combine that with the lift in global growth we're expecting next year, I feel pretty confident that it'll be quite a strong year for the Aussie dollar. Now, finally, on interest rates, the Reserve Bank has put interest rates down to what we would call the effective lower bound of 0.25%. They've indicated that that rate will stay there for 3 years because they're buying government bonds at 0.25%, which have a maturity of 3 years. Their forecasts worry me a little. They're only expecting unemployment to be 6.5% by the middle of 2022 and inflation to be 1.5%. Their targets are 2.5% inflation and 4.5% unemployment. So they are quite conservative in terms of the progress towards achieving their targets. And underlying their forecast is a 6% growth rate for Australia next year and a 64-cent Aussie dollar. So there are some real risks around their underlying assumptions behind those forecasts. So we cannot discount the possibility that the Reserve Bank will realise in the second half of next year that they are underachieving in terms of their targets quite significantly. So what could they do? Well, I have argued in other places that the debate around negative interest rates should remain alive and well. My view is that negative interest rates would be extraordinarily successful for Australia to bring down the Australian dollar. We've never actually seen an experiment with negative interest rates in an economy where you have substantial foreign liabilities. Those economies that have had negative interest rates, Japan, Europe, Switzerland, Sweden, have all had large foreign positive have had net foreign assets. And so the need to borrow in those markets has been much less. So if we think about Australia offering a negative interest rate in those global markets, investors would have to be attracted to a much lower Australian dollar before they would become involved. So I think that if the Reserve Bank is unsuccessful in achieving their underlying growth assumptions, and that starts to show up in a lack of success in getting anywhere near their forecast for 2022, we may well see the negative interest rate debate emerge strongly in the second half of next year. Thanks a lot, Melinda. I've probably said too much.
Oh, definitely not, Bill. There's no such thing. I think the challenge for you at the moment is there's just so many questions and uncertainties. And to be honest, there were at the end of last year already. And now we've got, multiple layers of additional uncertainty on top of that. Let me just put a bit of a summary, if I can, over the top of your comments. So I think seeing a recovery in economic activity next year, but nowhere near as bullish as the Reserve Bank, really raising issues around the outlook for the labour market. And I think, like others, not just in terms of the unemployment rate, the measured unemployment rate, but hours worked, because we're seeing this reduction in the participation rate. But I think also you sort of touched on some issues around that potentially influence confidence, including the house price outlook, which we all know can have some significant wealth effects in terms of certain patterns of consumption that are important to seeing consumption activity picking up. On China, I think, being pretty clear that you see about a third of the exports that we provide to China at risk, and that's a pretty significant number, I think, because if you would look at the growth that would be needed in other export markets to compensate for that, I think there's a big question mark over whether or not that those markets exist for Australia at the same level. And then finally, talking about markets, I continue to be amazed that anyone wants to forecast the Aussie dollar. I gave up on that years ago, and I feel better for it, I have to say. But let me put a question to you, if I can, Bill. You talked about the consumer sentiment numbers. I have to say I was surprised by the rebound, and obviously noted the fact that you were saying it's still come up to a level which has more pessimists than optimists. But I'm interested in your thoughts around the extent to which that confidence is being driven by health outcomes, and that at some point in time we're going to see people shifting to what they think the economic outlook is, and how you think they're going to feel about that, because I think you're flagging quite a few uncertainties or potentially some data shocks, if you like, in the next 3 or 4 months that might weigh on consumer confidence. And secondly, you talked about the need for the budget to continue to support domestic demand, which I completely agree with. But I think one of the real challenges for the government is to think about the measures that are likely to actually flow through to the economy. So you talked about some tax cuts potentially. I think there's a real question about the extent to which those tax cuts might be saved. What we're seeing at the moment is the payments through JobKeeper and JobSeeker really supporting consumption, and that seems to be what the data is suggesting. So I'm just interested in, when you're talking about boosting demand through the budget, what do you think is going to be the biggest, will have the biggest impact on consumption and domestic demand?
Okay, so firstly on consumer sentiment, look, I think it's certainly true that the evidence that we dealt so much more successfully with the virus in other countries, and even though we've seen some flares, particularly in Victoria, the general view is that we've been very, very successful in that regard. And that was linked, of course, with a much earlier opening up of the economy than we were expecting. I think the Prime Minister wasn't really looking for much opening up in the June quarter. And of course, now we're seeing that coming through quite strongly now. And really the month of July is going to be another strong month of opening up of the economy. So I think it was that surprise factor that came through in May that was important. And of course, people are believing that as the economy reopens, so demand will pick up. The other interesting factor was that they're quite optimistic about their job security. In fact, the question about the outlook for the unemployment rate over the next 12 months is back to above normal levels, and that's not what we'd seen in previous recessions. So that does remain a bit of a puzzle to me as to why people feel as secure as they do about keeping their jobs if they've currently got a job. But that's certainly one of the other factors behind their confidence. Areas where they're less confident is around their own finances. And we often find that how they feel about their own finances is a really reliable indicator of how the sort of longer term trend on their spending goes. So we were delighted to see that, we came out with that story in early May amid all the doom and gloom, that confidence had rebounded 16.4%. And I think that was certainly a harbinger of what followed through in the spending story during the month of May. So it's been a pretty reliable indicator so far, but I would be quite cautious about the index lifting further from these current fairly ordinary levels, but obviously much better than the collapse that we'd seen before. On the government story, it's going to be hard for the government. I guess if I look at the pass-through to the economy from the tax story, I would be much more confident that we'll see a pass-through to the consumer in spending that than I would from corporate tax cuts. My view is that corporate tax cuts will be saved. I think that corporates will only really boost their investment and employment if they perceive a sustained lift in demand. And I think the best way to lift that demand and to encourage expectations of that is to boost the income of the household sector. Now, clearly, other ways in which we can do that is to lift productivity and find a way to much more closely align wages with productivity. And their factors.
Someone's got Siri going.
I'm sorry. I think one of the other ways would be to lift productivity, and a way to do that, and if we have a more efficient industrial relations system, so we can align wages with productivity, then we can get the lift in incomes in that way as well. So I would like to see the emphasis being in that way. Certainly, government spending can boost demand, but I think it needs to be constrained by the government spending that boosts productivity. I'm not a great supporter of government spending just for the sake of it. I think it needs to be there to boost productivity.
So that allows me to ask you a follow-up question from our audience, Bill, which is really a question around, get the need for, in my words, macroeconomic stability and supporting demand, but what are the constraints for Australia in terms of how long and how long they can run a large deficit for, essentially?
Well, I think that we're still in pretty good shape. If we look at Australia relative to the US, their debt to GDP ratio is heading towards around 120%. We thought that with the original estimates for JobKeeper, it'd be about 34% for Australia. Now it'll be lower than that, in the low 30s. Admittedly, we could never run the sort of deficits that the US is running because we don't have the reserve currency. We have to fund our foreign liabilities in the world, and so we have to generate some degree of confidence in terms of our government debt. But I think at those levels, taking on more government debt now rather than accepting those long, painful periods of an elevated unemployment rate. And as I referred to before, the early 90s, 15 years before we got back to the previous low, 6 years in the early 80s. GFC, the unemployment rate was 4% before we went into the GFC. I think the low point in this cycle was 4.8. And that period was marked by fiscal austerity, in my opinion. Now, that's worked out in a way successfully because we have more flexibility to deal with this crisis. But I think going forward, we need to balance the decisions more towards boosting demand than fiscal conservatism.
Yeah, I think that's a really interesting point, Bill. And we've seen the government already announcing, I think, efforts to do just that through the infrastructure spend, which is obviously geared towards creating jobs, but also longer term kind of boosting the productive capacity of the economy. But the budget work that we at CEDA did a couple of years ago highlighted actually just how much the improvement in the fiscal position had been achieved through cutting expenditure. And yes, that's given us a good position now, or a better position than would otherwise have been. But I think it's a really good point that you raise around how we think about the right structure of the budget going forward, not just in terms of getting back into a reasonable position vis-a-vis the deficit, but also its contribution to supporting the economy more broadly. I have to thank Nick for that question. I'm sorry, I forgot to mention Nick's name when I asked the question. Bill, let me ask you another question that's come through, and let me frame it up this way. We've seen through this crisis, one of the sort of silver linings, if you like, is the extent to which business has been able to respond more quickly than it might have expected, and the government for that matter as well, in terms of adopting digital opportunities, whether it's telehealth or digital retail opportunities, etc. The whole sort of technology, digitisation area is one identified as a potential driver of future growth. I'm interested in your thoughts on that, and also specifically, whether some of the changes that we've seen businesses implementing and now talking about are going to be sustained and how you're factoring them in. So, for instance, business talking about reducing its travel significantly. So there's been a big shift. How much of that essentially do you think is going to continue on, and how is that factoring into how you're seeing economic activity?
Well, obviously it won't continue on at the current level of intensity once foreign travel is possible again. But I think you're right. I think that businesses will look at the margin and say, do we need to impose this 24-hour flight to Europe on our workers when we can do these very efficient Zoom links? And you only need to look at the US share markets, and look at those, people say the US share market's rebounded dramatically. It sure has, but there are many companies that are associated with the old economy that haven't done particularly well, and it's been the technology companies that have been really leading the way. And so if we think about air travel, that'll be a huge rebalancing. If we think about commercial property, the question there is, will the number of people that will work more permanently from home using technology mean that occupancy rates will fall substantially in buildings, or will it mean that there'll be a fully offset from people needing more social distancing within the office, and so businesses will still need the same amount of space? I suspect whilst there will be an offset from the latter, I think the former will be a substantial concern for commercial property as well, and occupancy rates. And that, of course, is a big driver of growth in the Australian economy. So we can have a lot of interesting discussions on picking off various winners and various losers in this environment, and technology is certainly be one of the big winners.
Well, you talked about immigration briefly. Let me put that front and centre. If you look at the GDP numbers that we've seen in recent years, you've talked about the fact that we haven't had much by way of productivity growth. Population growth has really underpinned the strength of GDP, population growth and increasing hours worked. And of course, immigration is a really strong driver of Australia's population growth. We're not seeing that at the moment. Big question mark about when we might see a return to international movement of people, but also I think the appetite for immigration levels of the type that we'd seen in recent years is probably going to be an issue up for grabs, if I can put it that way. How do you see the outlook for immigration? What does that mean for the economy?
I'm really worried about that, Belinda. The Prime Minister, as you know, indicated that the level of immigration in 2021 would be 15% of the level that we saw in 18-19. That's a huge collapse. And of course, as you said, our population growth around 1.75%. 1.25% of that is due to immigration. So I think we should not accept that as being a fait accompli, because the impact that will have on the housing construction cycle, on overall demand, on potential growth. So if we talk about underlying population growth being more like 0.5% rather than 1.75%, then we're talking about GDP growth of around 1.5% on the optimistic assumption that we can hang on to that 1% on productivity. So potential growth of 1.5 compared to 2.75 would be a disaster for us. So we have to find out ways to address that potential collapse in immigration. I think we have to look at different ways of looking at quarantining. Look, I'm not an expert on immigration, but I would have thought that a permanent immigrant would be quite happy to do a 2-week quarantine. So I think we really need to address that sort of a problem. And obviously a lot harder with short-term migrants and the student issue, but I think we need to address that as being something that's been critical for our growth. We can't just accept the fact that foreign travel means that comes to an end.
Yeah, I think it's really important as well. We did some research last year on temporary migration. And so you've identified the really critical role that permanent migration has played, but temporary migration as well is a really significant contributor both to growth more broadly, but also to productivity. And our program, which brings in generally people with high skills, that actually contributes to the overall skill level in Australia and has been a really important driver of growth. So I think it is an area where we're going to need to see, I think, a deeper conversation about what the current situation means for our future prospects and how we actually bring the community into that conversation so that the benefits to the broader community are better understood than perhaps they are at the moment. Just in terms of the impact on housing, you flagged obviously the impact of lower population growth and immigration on housing. Dominic had a specific question too about how significant you thought the home builder package would be in terms of potentially offsetting some of those negative impacts from immigration and what that might mean for the construction sector.
Well, I think it's a positive, but looking at the guidelines, it looks quite restrictive. I think it may work better in regional areas than it will in the cities where the cost of the properties is much higher. If I look at the number, it's about 800 million. That's not a very big number. We're talking about 130 billion we were about for JobKeeper. So I would have liked to have seen a bigger number because I do believe that the housing construction cycle is going to be a major sufferer in this profile. We're currently expecting to see about a 50% fall in building approvals by the end of the year. Housing will be a sort of a slow ticking bomb on this one. The data at the moment is holding up pretty well, but the lags are much larger. So forward order books for builders and that, I think builders would be getting nervous now. And so the outlook for next year, I think, is going to be a big challenge. Hence my caution that growth next year will only be around 3% compared to, say, the RBA's 6%. The other point about immigration that I forgot to mention was that if you look at those previous recessions, you do see a correlation between a fall in immigration and those high unemployment rates. So governments do have a propensity to try and deal with their excess labour issue by restraining immigration. And that debate, I think, will come back onto the centre stage again. That issue about immigration does boost productivity, it boosts demand, but it also boosts the oversupply of labour at a time when we have high unemployment. I've heard that one before. We heard it all through the 90s, and I've no doubt it's about to replay now.
Yeah, I think so too, which is why I think we need to try to continue to make sure we have a really broad conversation about it and we put all the evidence on the table. I mean, the analysis that we did showed that, particularly from a temporary migration perspective, actually that boosts economic activity, and that in itself then creates more job opportunities. So there can be some benefits, and of course, some of the skills that we're bringing in are skills that are in quite short supply in Australia. So there is a broader conversation there about how we get that skills match right. But for businesses that are looking for skills, particularly in the likes of, programmers and developers and ICT business analysts and things like that, there is, a need for those skills, and migration does help to fulfill that. So anyway, a conversation for another day. We could go on for that forever, I suspect. I've got a question from Rohit, who I think wanted to come back on your outlook for the Aussie dollar. And I think he's probably asking a question that many want to ask, which is how, if you see the currency as almost a sort of an indicator of the strength of the economy, how can you be forecasting a rising Aussie dollar when we're talking about recessions, talking about 3% growth, pretty tepid? So maybe just talk us through your Aussie dollar forecast a little bit more, if you wouldn't mind.
Well, currencies are always a relative game. So whilst we're talking 3% growth next year, we're also talking about the world economy, the major economies being in a fair bit more trouble. I think the Aussie dollar against the US dollar, my view is that the US dollar is pretty near its peak. I think we're pretty horrified about the way the US is dealing with the COVID issue, and that is going to be ongoing. So for me, that's a pretty important positive for the Aussie dollar. The Aussie dollar's long run average is 77 cents since China started to industrialise back in the early part of this century. So I'm only looking at the Aussie dollar to get back to around that long run average. As you know, post GFC, when China had its massive stimulus package, the Aussie dollar got to above parity. Now, part of the reason behind my thinking is that China will be focusing on filling that gap that is emerging in their economy in the household consumption sector, as they remain cautious around the COVID risk, China needs to continue to create jobs to avoid unemployment demonstrations, etc. So I think China's demand for our commodities will be important. And I think the global risk environment, whilst it may well have some pluses and minuses in the next few months as the US COVID problem waxes and wanes. My view is that with the support of the Federal Reserve and other central banks and government policies and the likely turnaround in global growth next year, this is a pretty constructive environment for the Aussie dollar. But having said that, I'm still only looking for it to get back to long run average. I'm not looking for it to have one of those excessive tears that we saw after the GFC.
So let's stay in markets for a moment. I've got a question here from Jason. I think you'll like it. It's the one that emerges from time to time. Share markets are pricing in a swift recovery. Bond markets and the gold price on the other side of the coin. Which one's right?
Look, I think they're both right. Actually, I think the key factor here is the US Federal Reserve. And they have indicated they'll do whatever's necessary. They've indicated they're not investors, they're only lenders, but they will continue to buy securities, including government bonds, and that supports liquidity in the economy, which will support equity markets. Also, I think it's true that whilst the growth environment might feel challenging, I think as we go forward, it will improve. My view is that even though we may see second waves of the virus, particularly in the US and in parts of Europe and possibly even China, governments will react differently this time around. I don't think they'll want to go back to closing down their economies. I think they'll want to manage it with more cautious policies, and that'll continue to support growth, which will help equity markets. But at the same time, you've got these central banks doing quantitative easing, wanting to hold down bond rates. Now, that can't continue forever. As the central banks feel they've done their job and global economies start to move more on their own momentum, then bond rates will gradually lift. So, for instance, the Australian 10-year bond rate that's currently 0.9, I'm expecting that to be up around 1.4% by the end of next year, under the weight of an improving growth environment, but also under the weight of the huge supply that we're seeing coming out of governments. And at some point, central banks will take a step back because they feel they've done enough work to avoid the great crises that we've been through.
Yeah, it's interesting. As you were talking, Bill, I was thinking you mentioned that you've been at Westpac since the recession of the early 90s, and of course, interest rates then in the lead up to that recession were nearly 20%, right? Let's ballpark it up to sort of 15 to 20%. It just seems remarkable, the interest rates we're talking about now, doesn't it? Can I come back on the equity market point? So I get the fact that lower interest rates support equity markets, but at some point you've got to get earnings, and whether it's the Reserve Bank forecast or the IMF forecast, I haven't seen a single forecast that puts the level of economic activity in Australia or in any of the other major economies at the end of 2021 higher than 2019. So, I mean, are they just equity markets just looking through 2 years of no growth?
Look, I think they're obviously always ahead of the economy. So they're always looking at where they see the economy going rather than where it is today. And I think they're basically saying that the key driver of the economy this time around is government policy to deal with the virus. Rather than in previous cycles, it was more difficult to work out exactly what the policy was going to be. Let's think about Australia in the 90s recession. The reason for that recession was government policy pushing interest rates too high, and then a very, very slow, languid fiscal response. And we can think about that when we look at the deficit to GDP. The deficit in the early 90s peaked at about 4% of GDP. Almost all of that was the cyclical deficit, very little fiscal support. whereas this time around the deficit will peak momentarily about 8% of GDP, where more than half of it is government support. So there's recognition that governments are prepared to do a lot more, act a lot more aggressively, and support economies. And I think equity markets are certainly responding to that. Now, as we discussed before, there'll be some winners and some losers. And so equity markets are pretty good at working that one out as well. And we have to accept the fact that that technology story still looks pretty convincing to me.
Thanks, Bill. I'll bring you afterwards and you can tell me what stocks I should be investing in. You touched on the fact that you think governments are going to respond differently if we get a second wave of virus transmission. Here in Victoria, we're seeing a little bit of that now. How big a deal do you think that is in the context of the economic outlook here? And, if borders within Australia remain closed for longer, is that something that knocks your thinking about the economic outlook around significantly?
Yes, I think the border story is an important one because one of the drivers of growth that we're going to see is that rebalancing of foreign travel towards domestic travel. So there's a big hole in the domestic travel market as a result of no foreigners coming, but the actual amount of money Australians spend offshore is greater than the amount of money that foreign visitors spend in Australia. So rebalancing that spending towards the domestic economy is going to be very important. And relaxing those borders is going to be important as well. On your bigger point, I think we need to cast our mind back to March when governments reacted as decisively as they did. And at the time, the advice that was being received was that Australia was going to need between minimum 3,000 intensive care beds, maximum 6,000 by the end of April. And Australia only had about 800. So you can understand why governments would react very aggressively to that sort of a prospect. But we've now had a number of months to build the supply of the intensive care beds. So that particular dilemma for governments is no longer as immediate as it was back in April. And that's why I think they can possibly err on the side of giving more support to growth and being more cautious on dealing with the health issue if we were to see a major outbreak again. I don't expect that to be the case, but I just think that governments, and I expect this will be globally, that governments will be very reluctant to go back to the sort of shutdowns that we saw back in April.
Yeah, thanks. We've got a couple of minutes to go, and I thought maybe if we can just close out by just taking a bit of a step back. You've been forecasting the Australian economy for a long time now. We've talked about the recession of the early 90s. You've mentioned the global financial crisis. On the way through, we've also seen the Asian financial crisis, which for a period of time there was great concerns about the contagion effect into Australia. And now here we are with this completely different crisis. How does it feel trying to forecast in this environment compared with other moments of sort of great uncertainty? Does it feel like the degrees of complexity and uncertainty are far greater now, or is this just a crisis of a different making, but kind of similar in magnitude to what we've had to deal with before?
Look, I think if we look at most other recessions, they're a result of government policy mistakes. As I said, in the early 90s, was pushing interest rates to nearly 20% and then having a really, really slow fiscal response. In the early 80s was a fairly similar story. The Asian financial crisis, of course, was an external shock. And what stood Australia in tremendous stead there was the fact that the Aussie dollar fell into the 50s and acted as a massive shock absorber for us. This time around, the cause of the crisis is not a government policy mistake. It's a government having to respond to a health crisis. And so it's harder to read. It may be harder to read in the sense you can't really read the outcome of the health developments, and of course that's a factor. When do we get a vaccine? Can we actually get antiviral treatment earlier? Those sort of uncertainties are huge. But I think we can also think that the recovery is more in the hands of government this time. They have indicated a preparedness to use their instruments a lot more aggressively than we've seen in previous cycles. And I'm talking not only about Australia, but right across the world. So I feel that this one will certainly, we will see that gradual recovery next year. But unfortunately, that high unemployment rate is going to be a legacy that we'll have to deal with after this crisis in the way we've dealt in other crises. Let's just hope it's not 15 years before we get back to the previous unemployment low, which was around 5%. Let's hope that we agree that that is the biggest price that economies pay, and we have to be much more aggressive with policy to deal with that.
I think we're already seeing signs that maybe the policymakers are getting their heads around that too, obviously with commentary in recent days from the Reserve Bank Governor Phil Lowe, talking about perhaps rethinking whether inflation targeting is the way to go. When we did our State of the Nation forum last week, of course, this issue of the outlook for the labour market was front and centre. And, you know, one of the things that came out, Bill, was just this real focus on what people are now referring to as the Pink Recession, so that, you know, unlike some of those other recessions where really the bulk of the employment shock, if you like, was felt amongst working men, that now we're seeing, you know, women and younger people being the first ones into the unemployment queues. And there's really a questioning too about the capacity of government to target spending in a way that's actually going to create jobs in those areas as well. So infrastructure spending, great, but is that going to create the jobs for the people who are losing them now? So I think, you know, obviously very much an issue on people's minds. I'll just give you the results of the poll that we had running while you were talking, Bill. The question that we put to our audience was, last week the Prime Minister said Australia is currently in the recession we shouldn't have had to have. What do you see as the best strategy for stimulating economic growth out of the crisis? 17% said corporate and personal tax cuts. Of course, you addressed that in your comments, Bill. Investment in skills and development, 23%, possibly in response to some of our comments on immigration, which I should note one of our participants described as business as usual, lazy economic drivers of growth relying on immigration. I'll come back on that one on another day. Digital transformation of the economy was seen as important by 20% of our audience, infrastructure projects 20%, and stimulating private sector investment 20%. So pretty even spread. I think that highlights the challenges before the government as they contemplate what looks to be the need for and the opportunity for a really significant reform agenda here in Australia. We are coming close to the end of our session. Bill, I'd like to thank you so much, one, for continuing to support CEDA, as you do so often in providing us with your insights on the outlook for the Australian economy. It's great that we can have someone with your experience and skills and insights to bring to our audience. And I know we always get tremendous feedback. So thank you so much again for your participation today. To the audience, thank you for joining us. We will keep the Pigeonhole app open for another 15 minutes. So if you've got further questions that you'd like to ask about the outlook for the Australian economy, send them in and we'll try to get answers to you on the issues that are most on your mind. Finally, can I just say, I'm going to put another plug in for the content that we've got available on our website. Our research and policy team has been working double time to provide you with insights, interviews, blogs, commentary. There's a wealth of information there, so please do have a look at ceda.com.au and you'll get all the information on our upcoming live stream events as well. Thanks so much for joining us today.